I think we're going to continue to see the trend that we're seeing now expand. And the trend that we're seeing now is utilities are starting to step up in the long-term contracting market. And there's a few specifics I can give you, which are there's multiple large US utilities that are in the long-term contracting market with RFPs for smaller volumes. So these are the big boys, the Constellations, the Dukes, the Dominions, the Vistras, they're all kind of sniffing around and testing the waters with small RFPs, 100,000 pounds delivered over 6 years, 2027 to 2033 period is where they're kind of focusing. That to me looks like they're testing the waters.
Hello, everyone, and welcome to another edition of Triangle Investor Interviews. I'm your host, Lucian Valkovic, and before I announce my guest, just a quick reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy or sell any shares, products, or services. Always do your due diligence and consult with your financial advisor. And my guest today is Justin Huhn from the Uranium Insider. I believe Justin needs no further introduction, a very well-known and respected name in the industry. Justin, welcome back to the show. I always enjoy our talks.
Same here, Lucian. Thanks for having me back. It's great to see you again.
Same here. Let's jump first on WNA. The upcoming WNA Symposium will be 50. Will celebrate 50 years of the symposium, of course. I want to address that first. What key themes or discussions do you anticipate will dominate this year's event, particularly regarding uranium supply constraints and nuclear energy role in the global energy transition?
Well, to be honest, Lucian, I haven't actually looked over the scheduling for the sessions at the conference, but these conferences really more than anything are all about the personal connections and the meetings that are had outside of the conference. It's the conference every year that most industry participants actually attend. So there's other, more fuel focused conferences and multiple conferences in the US every year that are specifically more geared towards US utilities, but this is where everybody comes together. The miners, the utilities, the traders, the actual nuclear companies, like everybody is going to be there. And so it's all about the conversations. And I can tell you what I expect to be communicating with and to be talking with other people about is all about the long-term contracting market and the risk to supply going forward. That's really what everybody should be focused on, in my opinion, as far as investors that are long this sector or wanting to be long this sector is what is in front of us in terms of a utility demand in the contracting market, what is available on the supply side. And you put those two things against each other, it's a pretty stark picture that to us, based on our modeling of the sector, looks to be extremely supportive of higher prices. You even have the industry price reporters like UXC and TradeTech finally coming around and saying, like, the actual weekly product that UXC put out yesterday, the title of the intro article is "The Calm Before the Storm." And if you're familiar with UXC, if your listeners are familiar with UXC, this is very strong language coming from UXC for them to say, even just to have those words in a title and to be writing about what they did, which is essentially there's 2 billion pounds of demand between now and 2040 that are uncovered, that utilities have to come in and procure in the market. And the supply risks are absolutely there. There's going to have to be, the industry is going to be reliant for the first time, possibly ever, and with exception of the very, very first, decade to 15 years of, civilian nuclear, on pounds coming out of the ground, not on inventories and secondary supplies. So we have greenfield projects that must come online and must produce, and the industry is going to be reliant on that. And it's a setup that is ripe for disruption, but even without disruption, the supply and demand metrics are there to see much higher prices incoming. And we think that's already happening right now. It's happening in the background in the long-term contracting market, which has really started to heat up over the past few weeks.
We will unpack this a little bit more after I ask you this question. The WNA Nuclear Fuel Report is also going out, I believe, on September 5th. So it will reflect the unprecedented uranium demand growth driven by tripling, quadrupling nuclear capacity, big tax, all of it. What are your expectations for this report projections of the uranium demand and supply gaps, and how might these influence market sentiment?
I think that it has a pretty significant influence on sentiment. There's a number of people in the industry that are a little bit, let's say, not necessarily concerned, but they might just kind of brush off the nuclear fuel report mainly because it is going through the WNA filter, and the WNA has a lot of influence from nuclear utilities as well. Although their website, their free website, is unbelievably thorough, and you can get fantastic reactor data and mine data from the WNA. So they do really solid work. But the committees that are working on the supply and the demand sides that will ultimately result in the fuel report's findings will do the work that they're going to do, but ultimately it is going to run through the WNA filter. With all of that said, they always have the lower reference and upper cases. So they can have a lower case that's very conservative. They can have a reference case, which is to say their estimation of what is most likely to pan out. And then the upper case is like, if SMRs really go crazy, if we see military demand, if we see much greater expansion of new nuclear globally in the next, 10, 20, 30 years, then it starts to look like that. So regardless of how accurate the report is or is not, or let's say will be, because it's a future projection, which anybody that does that is going to not be perfectly accurate, right? You're making assumptions, especially if you go out beyond a few years. With all of that said, the visuals from that nuclear fuel report, the classic, pink kind of salmon colored backdrop, everybody knows this. And when you see it, investors see it and the utilities see it, it has an impact. So it would be wrong to say that it doesn't matter because it will have an impact likely on the industry. With all of that said, I don't think that utilities really see that graphic and go, "Oh, damn, it's time to buy." They're dealing with their own budgets, they're dealing with their own inventory levels, and they're dealing with an environment right now that really is not very easy for them to operate in, especially in historical context. And you go back the last 25, 35 years, and it's a very different place right now in terms of supply and procurement. And it's not easy for utilities to buy and procure their needs in the market right now, and it's not going to get any easier either. So they're dealing with what they have to deal with. The fuel report is not necessarily the driver. The utilities showing up to this conference and talking to the producers, that's the driver. Because they're going to have meetings with Grant Isaac, and they're going to have meetings with Borshoff, and they're going to have meetings with all of the producers and to be producers and say, okay, what are you guys seeing out there? And Borshoff's going to say, well, look, you know, we've deferred our DFS, we've deferred our final investment decision because we are not ready to come in and build this mine yet because you aren't signing the contracts at the terms that we need. And that's just how it is because it's going to be expensive and it's risky, whatever. They have the conversations they need to have. They come away from the conference. Many utilities get new budgets in later part of Q3, early part of Q4, and they come back to the table. And that's really what it's all about is the individual communications between all of the different players.
Yeah, agreed. However, Borshoff will say, I'm not getting out of bed for this $80 uranium. That is definitely what John will say.
Yep.
Jokes aside, let's talk long-term contracting trends. How is the status of long-term contracting? Do you see any signs that it's picking up? And how do you see the long-term contracting cycle evolving over the next few months?
Over the next few months, I mean, that's pretty near term to make any kind of prediction, but I think we're going to continue to see the trend that we're seeing now expand. And the trend that we're seeing now is utilities are starting to step up in the long-term contracting market. And there's a few specifics I can give you, which are there's multiple large US utilities that are in the long-term contracting market with RFPs for smaller volumes. So these are the big boys, the Constellations, the Dukes, the Dominions, the Vistras, they're all kind of sniffing around and testing the waters with small RFPs, 100,000 pounds delivered over 6 years, 2027 to 2033 period is where they're kind of focusing. That to me looks like they're testing the waters. They're testing the depth of the market. They're testing the pricing structure. Of course, if you want 100,000 pounds delivered over 5 years, you can get that from a carry trader. If the pricing environment in the market is right. If you want higher volumes, you're going to be talking to a producer directly. So that's one element that is taken place and started to happen in the term contracting market over the last about 3 weeks. Last week, we had Korea Hydro Nuclear Power come in with a large tender, almost 900,000 pounds per year, delivered over a 10-year period out to 2036. This contract is the type of contract or the type of tender that this is typical for the Koreans, but is atypical for the industry. And that is that they actually dictate the terms that they're willing to accept in the tender. So most of the time, the request goes out and says, we need this many pounds delivered over this time period. What do you got? The Koreans say, we need this many pounds delivered over this period. This is what we're willing to pay. So they want a contract that is 70% market referenced, 30% base
Fixed.
escalated or fixed. No, they didn't put any terms in the fixed price of the contract, so that theoretically could be very high, although they probably wouldn't accept super high fixed. The 70% market referenced, they will not pay any higher than $65 floor or $101 ceiling, which if you're paying attention to this market over the last handful of months, you'll know that Cameco, for example, has been telling the market for over a year, we're looking at floors in the 70s and 80s and ceilings in the 120s, 130s. And they're, the largest publicly traded, 100% publicly traded company, uranium producer. So this looks to me like the Koreans are not necessarily with the times in the pricing structure in the market. We don't believe this contract is going to be filled on their terms. And it's highly likely that they're going to have to come back to the market with a tender with higher floors and ceilings request, and or discuss this off market with a producer directly and get different terms. So that is all to say that there's a lot of pent up demand for term contracts from utilities, because what they have done over the past 2 years, especially the past year and a half, following a very large price rise, is they've stepped out of the term contracting market. They've done a small amount of procurement in the spot market. They've bought a small amount of EUP to kind of avoid the whole fuel cycle as it's available. But they've also been able to flex up on legacy contracts. And this is the most important point to understand, because contracts in a buyer's market, when the price is declining, let's say, so 2011 to 2018, that entire period of time, yes, it recovered a little bit out to 2020, but that was a buyer's market, a bear market for the commodity. The terms that a buyer wants is fixed price across the board with a small amount of escalation. So, and you had, 0% interest rates for a while there. The escalation was likely negligible. Fixed prices that you could sign in the late 20 teens were probably, $25 to $35 a pound on the fixed side of things. Then you got into contracts that with a blended of 50% fixed, 50% market reference. So if you're a utility in this pricing environment and you're receiving deliveries from a contract signed years ago, and that's partially fixed at 30 or 35 bucks a pound, and you have a 30% flex provision in there, you're going to execute on that every time. And that every utility that has had a quantity flex in a legacy contract has flexed up to the maximum extent of that contract. And they've been doing that every opportunity. Of course, during the last few years, we've seen the market recover. We've seen the prices across the fuel cycle rise. This has become a seller's market, as is referenced by sellers wanting almost entirely market reference in these new contracts. Additionally, flex provisions are basically gone. Sellers are not offering quantity flexibilities in these new contracts. So the ability to flex up is disappearing. At the same time, the new contracts have no flex, are mostly, if not entirely, referenced to the market, and are going to be increasingly reliant on pounds coming out of the ground from a mine that hasn't been built yet. It's a totally different environment, and it's absolutely ripe for disruption. Even without disruption, the price is going to rise because the utilities have to procure. And the only people that are selling pounds that have available pounds to sell late decade in the 2030s want much, much higher prices than the environment that we're in right now. That's what's coming in front of us.
Great overview, Justin. Thank you for this. How is the situation with the spot market, traded volumes? What trends do you see there?
We've seen the trend actually decline in the spot market. So mostly this year, with the tepid long-term contracting, just over 30 million pounds year to date, which is insanely low. We've seen historically much higher volumes in the spot market, much higher volumes than carry trades. So the utilities have been procuring in the spot market as the price declined. The price went down into like $63 a pound. You had utilities in there buying. You had a lot of carry trades get done. So that has been a lot of the story this year is increasing spot market volume, increasing carry trades. There's also been a lot of enrichment purchase this year, like 50% more than last year, year to date. So that enrichment demand is going to trickle down into conversion and U3O8 demand. Not a lot of conversion in UF6 available. So you have, or not, especially UF6. So you have to buy that enrichment. You have to buy uranium in conversion, period. So the spot market volumes over the past couple of weeks, well, let's say 3 to 4 weeks, as we've seen the term market starts to rise in volume, the spot market volume is tapered off. And naturally, what we're seeing is the price has risen up into the 72 range. Utilities, it's kind of in a spot where it makes sense for them to come into the term market rather than procure in the spot market. It also is showing kind of an understanding amongst utilities that the price is unlikely to wash out back down into the 60s. And at this price, 72, harder to get a carry trade done. Still maybe enough of a spread there if the midterm price starts to rise a little bit, but spot market tapering off, term market coming into action. And that's really what we want to see.
Yeah. You described this summer's uranium market sentiment as the worst you've seen, despite strong fundamentals. What factors contributed to this negative sentiment, in your opinion? And how do you assess the current investor mood given the recent price of uranium?
I would say that the sentiment has gone from absolutely despondent in March and April of this year to apathetic here. I'm not seeing a lot of enthusiasm. I think that most retail investors, especially, all they look at is the spot price, and that's all that they're seeing. Whereas if you look at the equities, I mean, the equities have a bid here. They've got an underlying bid here. The sector did not give up the ghost in the way that everyone expected that it would. Everyone expected there was a historic run. URA was up 13 or 14 weeks in a row. The pullback was very small so far, right? That could change. We could have a washout tomorrow after I'm saying all of this. I don't know. I don't have a crystal ball. But the equities, they've got an underlying bid here. We think that the intelligent investors, institutional investors are kind of looking over the valley here and seeing what is coming in term contracting market. And the evidence is there that it is. That's the important thing. We're not just throwing out random predictions. How we think the price is going to do. We're seeing what's happening in the physical market. That's mostly what we focus on at Uranium Insider is looking at the physical market. What is going on there? More than anything, that tells us what is about to happen. So the despondency, it's hard to really say exactly, Lucian. I think there was a lot of confusion and concern with the new Trump administration a couple months in. The tariff scares was sending the markets down, to speak generally. So there was kind of risk off across markets. That didn't help. You also had, a handful of nuclear stocks that have kind of gone on moonshots and have sort of become meme stocks. And anytime something that you might not own is going through the roof, and what you do own that fundamentally and theoretically should be stronger isn't, that can cause investor sentiment to be very, very poor. And then, of course, just, sentiment and price action begets sentiment and price action. So when it's bad and it gets worse, it can get really, really bad. And I think that, it takes a lot of patience for a story like this to play out. And that's not something that everybody is okay with. That is not something that everybody is prepared to wait out. And it's totally understandable. There is opportunity cost in being patient with a trade, despite how high your conviction is that it will eventually work out. So largely, since the big move late 23, early 24, it's kind of been chop. We've had moves up, we've had moves down. Not a lot of equity price action to get really, really excited about. And it's hard to say we're even in a bullish environment here. I mean, maybe based on moving averages, but really this is a recovery from the washout that happened, Q1 into early Q2. So it washed out. We've gone back up. Some of the stocks have gone to new highs or even all-time highs, and those are largely like Cameco, which is more of a overall nuclear story stock. They've got full, integration across the fuel cycle at this point. Uranium conversion, they've got enrichment with exposure to GLE potentially at some point in the near future. fuel fabrication through Westinghouse, and then they actually have nuclear build outs through Westinghouse. So it's kind of a one-stop shop. Makes sense that it's kind of the leader. The uranium equities, I don't think are yet pricing in the uranium price environment that we're going to see here. So it's become more of a contrarian bet, I would argue, over the last few months with, is the price going to eventually rise? Is the fuel going to matter? And I would argue absolutely yes that it will.
Yeah, I will not ask you about specific stocks, but where do you see more undervaluation? Let's say on ASX, on TSX, and what specific groups have bigger potential upside, the explorers or developers? We know that producers are really performing well. Where do you see the value?
I honestly think I see a lot of potential value in both explorers and developers. So there's a couple of exploration stocks that are on our radar that have already hit fantastic intercepts with the drill bit with very nice mineralization. And the stocks are essentially being ignored right here. They're both a very similar market cap. That's somewhat of a hint here. And we also have some exploration that's happening, some joint venture exploration in the Athabasca that's starting to have some really nice sniffs from the drill bit. And that's just the excitement is not there in this market for exploration hits. It's just not. So that I think is a pretty big potential upside. There's also a number of developers that I think it's difficult, right? There's something called the Lassonde curve where you have the excitement of an explorer, and as an explorer continues to have nice hits with a drill bit, the stock can move up substantially. Then once they start to build a mine, oftentimes the stock can get hit and they'll run into problems because mining is hard. And we've seen plenty of examples of that. With all of that said, there's multiple developers that I think are extremely undervalued. So it's the producers right now that I think have really taken the cake. And that actually has plenty of historical precedent to say that the producers usually move first. And for it to be, Q3 or in 2025 and to say move first is still to say that after I've been following this since 2017 is pretty significant. But I still think that we haven't really seen kind of the mania phase of this market where the small and mid caps. So like UR&J, I think is a screaming buy here. On a risk adjusted basis, SPUT is probably the best thing on the board. So are we going to see SPUT, triple or quadruple like we could, a small cap explorer that has some nice hits? No, we're not going to see that. But in terms of the potential for drawdown from these levels relative to the upside, I don't think anything looks better. So I don't think we're going to see the spot price do anything to the downside significantly. Could we see markets go risk off for a short period of time and see it drop back down to low 70s, high 60s? Maybe that's possible. Are we going to see it go back down to 63? No, we're not. So the only downside here, really, from what we can tell, is SPUT going to a steeper discount. I think it's at about a 6% discount here. Could it go to double-digit discount? Yes, it could. And we could see another 5, 6, 7, 8% down from here. That's possible, but that's tiny compared to the upside this could have trading back up to NAV and the spot price going from 72 into the hundreds, which it will. So huge upside for SPUT on a risk-adjusted basis, especially. Plus, it's got liquidity for days. So it's something that everyone can buy. And it's highly liquid. With all of that said, UR&J and some choice developers is probably where I would be looking right now, and a couple of explorers, but that's a harder game to play. And clearly, the enthusiasm for the exploration sector in the uranium space right now is just not there. So, very contrarian bet to be buying explorers here.
Yeah. Where do you see the next M&A in the uranium sector? We saw some M&A in Wyoming, Teton Basin, some at Athabasca. Where do you see and which group will be included in the next M&A in your opinion?
Honestly, I wouldn't be surprised to see more happening in the United States. I think that there's a lot of smaller developers that are working towards production. There's a handful of exploration companies that I think have pretty decent assets that could get acquired or could be merging with other companies. But really, what's happening in the United States with the incredible support coming from the Trump admin for the mining side of things. At the same time, we have nuclear growth, life extensions happening in the United States. So there's so much momentum here for all things nuclear that I to contrast that with a number of people who are skilled enough to actually build uranium production is it makes sense to me that we'll see much more consolidation here. And there's a few companies that I think have been ripe for acquisition and or merging for years that I would not be surprised at all to see that happen. We could also see if the sector heats up a bit more, we could see some of these exploration stocks and exploration companies get taken out in the Athabasca. I think that there's a few that are proving out very sizable assets, and we'll see. I don't know. There's obviously, you look at a company like NextGen where you've had the big institutional guys for years say this is insane that Cameco isn't taking them out. But in Cameco always seems to be kind of looking at them from a distance saying, we're going to let them try first. I don't know. That obviously is an unbelievable asset, and it's something that very likely will be looked at with a sense of desire from larger companies, maybe once they get their final permits, which could happen as soon as, Q2 of next year. So looking at that, more will happen for sure. Exactly where and by whom is harder to say, but I think that there's some ripe takeout targets in the US to start with.
Yeah, sorry for jumping from topics to topic. How do you see the status of enrichment bottleneck? How soon will capacity with or without overfeeding match demand?
I don't really think we're going to see a major bottleneck in enrichment. It looks to me like there's significant enough expansion that it is happening relatively in line with the expansion in total nuclear capacity. So, the Chinese are building some enrichment. That, of course, is largely going to be filling their own needs. And they have minimal uranium assets. So they're working on a project right now in Inner Mongolia that has first cake in a can as of last week from the test project. Still going to be a few years before nameplate, but that might be their best asset once it's eventually producing. Urenco is expanding, Orano is expanding, GLE is looking at potential first production from Paducah. Of course, they're not producing EUP. They're going to be re-enriching tails and producing UF6, which will help with the conversion bottleneck. But I think there's significant enrichment. But I also, from what we can tell from our numbers, is that demand is going to be continuously rising, sufficient to say that we won't see a major expansion of underfeeding. So underfeeding is primarily something that happens when there's far more enrichment capacity than there is demand. And that allows you to take your excess enrichment capacity and spin material longer to a lower tails assay, a lower tails assay than was dictated in the contract that you are spinning that material for. So if you have a contract that says 0.25 and you've got excess capacity and you can spin it down to 0.22, you're actually using less of the UF6 than was provided to you by the utility, and you can sell some of that into the market. That's underfeeding. That's maybe 10 million pounds a year right now. And that was close to 30 about 3 or 4 years ago. So we've contracted significantly in the underfeeding scene. A lot of that, most of that is coming from Russia at this point, and Russia, as we know, has a huge build-out program, minimal uranium assets. So they're not underfeeding as much as they used to. The West is not underfeeding at all. And unless we see a much faster expansion of enrichment capacity, we're probably still going to maintain relatively high tails, mid point twos up to point three for the foreseeable future.
Justin, what is your data, your models telling you about global inventory in the world of uranium? How are those? Of course, we know that there is no exact numbers on that. How are your models looking here?
Inventories, commercial inventories are mixed. So the EU usually is better covered than the US, for example. They usually have 3+ years, which they do. The US is still right around that 2 year range, so they haven't really built your inventories significantly. They haven't drawn them down as much as you might think, considering the low levels of contracting. That has primarily to do with the flexing up on those legacy contracts, and like I mentioned, that option is dwindling and going away with time. The Chinese have a large inventory. They've got north of 600 million pounds of inventory, but that, of course, is strategic sovereign inventory. So that not only is across the fuel cycle, but that also includes military inventory as well, which we know that they've been building up also. So the total inventories in China are not something that we ever expect to see sold into the market because they're expanding their fleet so quickly. They're literally expanding by 10 reactors a year right now. So to speak generally, inventories for certain utilities and certain jurisdictions are on the lower end. The US is on the lower end, the Japanese are on the lower end, the Koreans are on the lower end. The Chinese are decently covered, but they continue to buy. The Europeans are decently covered, but they've got Um, they're decently covered towards the end of the fuel cycle. There's still significant uranium needs. Urano, of course, being state owned, and they've had a lot of problems on the uranium side. They've had SOMAR taken from them by the state of Niger, which was 5 million pounds a year. That's now gone from the French. So Orano's got some uranium problems, but they are expanding conversion and enrichment. All in all, commercial inventories amongst utilities are generally average to slightly low, but above ground mobile inventories for the industry are basically non-existent. And that's really the big part of the inventory story. And this is something that UXC wrote about 2 years ago in one of their weekly issues was the age of uranium, the age of inventory overhang is over. So we had a lot of inventory coming from utilities flexing down on their quantity flex options in legacy contracts during the 20 teens. So the same reason they've been able to flex up when the price is in a rising environment, they could flex down. They could sign a contract for 500,000 pounds and potentially only receive 300. That was extra material that was hanging over the market. Of course, Fukushima and all the excess inventory in Japan. Then you had the Kazakhs continue to ramp production. A lot of excess inventory. We think, according to our numbers, the amount of inventory overhang that didn't go to China
Mhm.
based on that decade from 2010 to 2020 was close to 200 million pounds of excess mobile inventory that had to be worked through from Cameco shutting down MacArthur River, Paladin shutting down Langer Heinrich, producers buying in the market. That took years. That excess mobile inventory was worked through, I would argue, about a year and a half to 2 years ago. Done. It's not there, and it isn't being built back up. So the inventory buffer that the industry has had the pleasure of relying on forever is actually gone right now. And that's really the biggest point. The
Yeah.
the supply that they're going to be reliant on for the next 15 years and beyond is going to have to come out of the ground, and much of it from projects that haven't been built yet.
Yeah.
That's new.
Yeah. You mentioned Niger. What's your take today on Niger? Is it still investable or not?
Niger is a tricky jurisdiction. It's so hard right now because obviously, Global Atomic and GoVX have development projects there. Global Atomic is much further along in a much larger and higher grade project. But the country is still under junta rule. And they just nationalized a gold mine. They took SOMAR from the French. They basically kicked the French out of the country. And the Russians and the Chinese have effectively moved in. The Chinese have built an oil pipeline there. The Russians are there poking around. So it's a tricky situation. At the same time, there is some evidence that looks like the U.S. is getting interested again in reestablishing a presence in the Southern Sahara region, to speak generally, and in Niger specifically. So could we see some stabilization? Possible. It's not looking all that fantastic from a risk perspective as an investor. It's not a place like the US or like Canada or even Namibia in Africa, which are much safer jurisdictions for investment. With all of that said, if things shift in a good direction in that country, the companies operating there are going to have re-ratings, insane re-ratings. But you could argue a company like Global Atomic is the cheapest company on the board and is not even close. So fingers crossed that things move in the right direction there. At the very least, looking at uranium production out of the country with SOMAR at least non-operational right now, somebody is probably going to take that over, whether it's China or Russia or who knows. That uranium will eventually come back into the global marketplace, but for now, it's a bullish thing for supply as far as investors are concerned to see problems happening in the country.
Definitely. I left the hardest question for the end. When moon, Justin?
I had a feeling that one was coming. I'm gonna say soon moon, Lucian. I'm gonna say soon moon. I don't really like to make near-term predictions, and I don't want to throw out any price predictions, but most likely this sector over the next many years, we're gonna see higher highs and higher lows and really strong moves to the upside, really gut-wrenching pullbacks, and I think we're on the cusp of the next strong move up. And that's not just because that's what I'm hoping for. That's what I am expecting to happen based on what I'm seeing in the physical market. All of the signs are there that a move up is coming, and you even have UXC telling you as such with the calm before the storm as their headline this week. So Yeah, I think a very strong move is coming, and I think uranium is going to finally have its day after the last 18 months have been so fantastic for the nuclear stocks, which is great. But the uranium story, the miners are going to generally trade with the metal. And as the price goes from 70 to wherever it's going, then we start to say, oh, this company is getting get into production in the next 12 to 24 months. What does that look like at 120, $130 uranium? It looks very different from $70 uranium.
Yeah, yeah. Justin, how can people reach out to you and become your subscribers?
Visit uraniuminsider.com. You can reach out to me on Twitter or X. I have a decent presence there as well.
Justin Huhn, aka Uranium Insider, thank you very much for joining me today.
It's always a pleasure, Lucian. Look forward to seeing you in London in a few weeks.